Right, it is noon, Arizona time. So we're going to get this thing going. It's supposed to be pretty quick, so I'll get you guys back on your lunch breaks or whatever you're doing. But this is episode one of this video series. We're going to have a couple more hopefully coming out for you guys, but today is all about life insurance. So first thing I wanted to do here is discuss Springberg Wealth Management. So we were established in 1973 by my grandfather, Jerry Springberg. He was actually Mojave County's first certified financial planner, originally called the firm Investment Insurance Designers. Current day, it is operated by my father, Brian, and I as Springberg Wealth Management. Focuses include life insurance, investments, and retirement planning. Me personally, I was born and raised here in Lake Havasu City. Graduated in 2019 from the University of Arizona with my degree in economics. And then shortly after I moved to Scottsdale, started working with a firm called Equitable Advisors. That's where I got my start in the industry. Licenses and designations. So I want to take a second and look at these. These are my current licenses, Life and Health, Series 7, Series 66, and then my Certified Financial Planner designation. Something to be aware of when you're working with a financial advisor, whether it's me or anybody else. You have these three licenses on top, the Life and Health Series 7 and 66. These are what allows an advisor to provide almost all products to their clients. Be very wary of financial advisors out there with just their life and health designation. While they might have your best interest in mind, if they can't offer all of the products out there, then even though they want the best for you, they might not be able to do the best for you. So just something to keep in mind. And then certified financial planner designation is kind of a cherry on top there, just because in order to achieve that designation, you have to show proficiency in investment planning, retirement planning, insurance planning, estate planning, tax planning. So if you're looking for an advisor, definitely look for somebody with those credentials. But let's get into the life insurance. So some terms to know. First one is going to be your premium. So this is what you actually pay to the insurance company in exchange for coverage. The amount of that is going to be determined by your age, your health, your gender, and your occupation. The younger you are, the cheaper it'll be. The healthier you are, the cheaper it'll be. Believe it or not, women statistically do live longer than men. So life insurance is cheaper for women. Occupation. This one doesn't come into play too much, but compare somebody like me who works in an office with an underwater welder. Well, obviously, I don't have the same perils that they might. So depending on your occupation, that might affect it as well. Death benefit. So this is what the insurance company is promising to pay out to the beneficiaries when the insured passes away. Now, as long as the policy is structured correctly, this is typically going to be tax-free, which is huge because you see these policies out there with death benefits of $500,000, $1 million, $2 million, and these beneficiaries are receiving these lump sums 100% tax-free as long as it's done right. Now, the point of life insurance is not to make your beneficiaries rich. It's just to make sure that they're taken care of. And the beneficiary, as you can tell, is the recipient of these death benefit proceeds. The definition of life insurance is essentially that it's a legal contract between an insurer, typically an insurance company, and the insured, where the insurance company is promising to pay proceeds to the named beneficiary in the event the insured passes away. This actually dates back, this concept, all the way back to 1583, the first life insurance policy noted where William Gibbons insured his life with Lloyd's Underwriters. He did a 12-month policy, and believe it or not, he actually did pass away in month 11. So his beneficiaries were paid out on that policy. In this case, it was his business partners. So let's go over some general uses of why you get life insurance. First one, burial expenses. Now, this comes surprising to many people where the average cost of a funeral is $10,000. Not a lot of people have that on hand to pay for something like that. So life insurance takes care of it. Income replacement. So this is a big one as well. Most households will have two incomes coming in from each spouse. If one of those incomes were to suddenly stop, that is detrimental to the ability of that household to afford their everyday life. It's even worse when it's a one income household. If that breadwinner suddenly passes away and can no longer provide income to the house, then that is huge detriment to their financial picture. So life insurance takes care of that as well. Debt relief, another big one. So think mortgage, car payments, credit card debt, any other debts you might have. You can include that into your amount of coverage when you're planning for life insurance to make sure those are covered for the surviving spouse. College expenses. So again, we go back to the surviving spouse picture where it's hard enough providing for the household on a day-to-day basis, much less putting young children through college. So life insurance can take care of that for you. Estate planning. So this comes into play with the more wealthy estates. Currently, the exemption before your estate starts getting taxed is 15 million. But what life insurance can do is actually provide liquidity to the estate, because something that happens with these large estates that owe a bunch in taxes is people have to sell off the assets, whether it's a house, car collection, whatever it might be, at a discounted value, something called a fire sale, just to provide liquidity to pay the estate tax. So life insurance is a big one there. And then lastly, business planning. So this one is huge. I use this one quite a bit. Something called a buy-sell agreement. And so what that is where, let's say there's two business partners, right? If one of them were to pass away, their spouse would receive their part of the business. Well, that spouse might not want anything to do with the business, might not know anything about the business. You guys might not like each other, whatever it might be. So what you do as business partners is you buy insurance policies on each other. That way, if one of you passes away, the other can utilize those life insurance proceeds to buy out that spouse. That way, the spouse receives what they're owed and you can focus on the business. Term versus perm. So there's two main kinds of life insurance. There's term and there's permanent. We'll go over term because that is really the most simple. It's pure insurance coverage. And so term insurance is just coverage for a set period of time, whether it be 10, 15, 20, 25, 30 years. That's kind of the time frame that's most common, but it is a set number of years that you are getting this coverage for. Guaranteed level premiums. So what I mean by that is once a term policy is in force and the insurance company says, hey, we'll give you $500,000 in coverage for 20 years at $20 a month. In that contract, they're guaranteeing you that that $20 a month will not change. So over that 20 years, it's $20 a month. It's stated and it's guaranteed to stay level. It's affordable. Again, it's pure insurance coverage. And I'll explain what I mean a little bit more by that in a second here. But because there's no equity in the policy, you're simply paying for coverage. If you pass away, it pays out. If you don't, you get nothing back. So it is the cheapest form of life insurance. And so there's no equity. There's no cash value. There's no investment aspect. So every dollar of the premium that you're paying is actually just going towards the life insurance coverage. And then the last piece on this one is all or a portion can usually be converted to permanent insurance. So the reason somebody would do that is because when you do a conversion, it uses your health rating that you received when you first opened the term policy. So as an example, let's say you get a 20-year term at 25 years old. 10 years later, you're now 35, you're making more money, you decide you want some permanent insurance, but in the last 10 years, some health problems might have come up. Well, what you can do is use this conversion privilege, if your policy offers it, to convert some or all of that term policy into permanent using your health rating from when you were 25. So a big one there. Permanent insurance. So just like it sounds, it can stay in force for your entire lifetime. The intent is for it to last as long as you do. It does have a cash value / investment aspect. So what that means is when you're paying premiums into a permanent policy, A portion of the premium goes towards paying for the insurance coverage, and the rest of it is going to go towards this cash value account. Now, how that cash value grows is going to entirely depend on the kind of permanent policy you have. And we'll get into specifics after this slide. But you can do a number of things with that cash value. One, tax-free withdrawals, policy loans against your own cash value. You can actually loan against your policy. And both of those are used to supplement retirement income. So very useful. And then lastly, premium payments. So if you structure your policy correctly and it has enough growth in the cash value, at some point you can actually just stop paying the premiums out of pocket and have them consistently come out of the cash value. So then your policy just pays for yourself until you pass away and your beneficiaries receive their proceeds. So different types of permanent policies. Whole life is one. This is a very outdated concept. I'm not really going to get into it. Most people don't use it. They often were not structured correctly, but it's just a term that's out there. So figured I'd put it on here. Universal life, index universal life, and variable universal life. Those are the three that we're going to cover today. When you see universal, all that means is that the premium payments are going to be flexible. And so what that means is, unlike term where there is a stated premium payment that you have to make no more, no less every month, these can vary. So with the flexible premium payments, they essentially give you parameters. They give you a minimum that you can put in to keep the policy in force and a maximum that you can put in to keep the policy in a tax advantage status. I won't get too much into the weeds on that, but just know that you have some room and some flexibility as far as how much premium you can pay into these policies. Universal, so has that flexible premium, and the cash value in these earn interest at a variable rate set by the insurer. So some policies are going to be more competitive than others as far as the rate that they offer, but typically it's going to be around the same and based off of the current interest rate environment. Now, these do typically have a guaranteed minimum rate of return. Usually it's at least 1%. These kinds of policies do typically guarantee that your cash value will not have less than 1% or 0% growth. But essentially, this policy is for somebody who wants to have a very safe form of investment for their cash value. Now, all of these policies, the universal, index universal, and variable universal, also have adjustable death benefits. So there's two options. Option A is going to be cheaper. The reason this option is cheaper is because the insurance company says, hey, you have your death benefit and you have your cash value. When you pass away, we keep the cash value and we pay out the death benefit. So it makes it cheaper for them to actually pay out the death benefit to the beneficiaries. In return, they provide a cheaper premium offer to you. Option B is where the death benefit and the cash value are paid to the beneficiary. So this one is typically going to be a little bit more expensive, but the beneficiary does receive both. So here's an example for you. Let's say you have a universal life policy, $500,000 death benefit, $50,000 of cash value built up. With option A, your beneficiary just receives the $500,000 and the insurance company keeps the $50,000 in cash value. Option B, your beneficiary receives $550,000 because they get both. Index universal life. Again, you see that universal flexible premium. But this time, the cash value is actually earning interest based on an index. And so the most popular one that you probably heard of is going to be the S&P 500. This is a statistical measure of the performance of the top 500 companies in the United States. Something to know is, even though you're participating in the gains of the market, it is not directly invested in the market. It is simply invested in an index that tracks the performance of the market. Now, the tricky part with these are the caps and participation rates. So, for example, indexes might have a cap of, let's say, 10%. So something that you might have is an index universal life, where your premiums are going into an S&P 500 index with a 10% cap. So for example, S&P 500 does 5%, you get 5% credited. S&P 500 does 10%, you get 10%. S&P does 20%, well, you get 10, and the insurance company keeps that additional 10 because of that cap. On the other side is the participation rate, same idea, just structured a little differently. So you might have S&P 500 indexes with an 80% participation rate. So in this example, S&P 500 does 10%, you're credited 8%. S&P 500 does 20%, you're credited 16%. So they typically are going to limit you on the upside. But in return for that, they limit your downside. So index universal life policies will usually have a 0% floor, meaning that you cannot lose your money in the investment. So they say, hey, we're going to cap you on the upside, but we'll also protect you on the downside. So this kind of policy is for somebody that wants to participate, indirectly in the market, have some potential for higher returns than just the stated interest rate of the universal life, but also have some protection on the downside as well. Last one, variable universal life. So this time, the cash value is actually invested in a portfolio of market-driven sub-accounts. So what's a sub-account? Essentially, that is the insurance policy version of a mutual fund. A mutual fund is a collection of anywhere from 100 to 200, 300 maybe different stocks and bonds. And these funds are professionally managed by a fund manager. But something to know with these VUL policies is that you can actually construct an actual market-driven portfolio in there. So you have your aggressive sub-accounts, your moderate sub-accounts, your conservative sub-accounts, your even a guaranteed accounts usually in there as well. And so depending on where you are in your time frame or how you are as an investor, you can construct a portfolio suited to your needs. But there's no cap and there's no floor on the performance. So the VUL policies actually provide the potential for the highest returns, but then remember, on the downside, there's no floor. So you also have the potential for loss. So these policies are typically for somebody that has the time to be in the market and feels comfortable investing in the market. But it's a great product for the right person. So why do term? The reasons to do term, again, one, it's affordable. That's the big one. Two, you only need a certain amount of coverage for a specific amount of time. And three, it allows you to lock in coverage when you're young. Kind of goes back to the affordability thing, but it's a good idea to get term when you're young just because it is so relatively cheap. Permanent. Now, this is for somebody who wants to guarantee a payout to their beneficiaries, because as you might guess, we don't know when we're going to die. So if you have a term that only lasts for a certain amount of time, you are essentially gambling that you are or are not going to pass away in that time frame. With a permanent policy, well, it's supposed to stay in force for the rest of your life, so you're essentially guaranteeing a payout to the beneficiaries. And two, can be used as a tax advantage investment. I want to touch on this one real quick in a little more detail. So the next video we do in this series is actually going to be on IRAs, Roth IRAs, and rollovers, and we'll touch on this as well. But the Roth IRA actually has an income limit. So if you make too much money, you cannot utilize a Roth IRA, which gives you tax-free distributions once you meet certain parameters. Now, people still want a tax-free bucket when they get to retirement, but what if you make too much? Well, then people can look at permanent policies because of those tax-free withdrawals and policy loans. There is no income limit on insurance. So there's a lot of people out there that make a lot of money that utilize permanent insurance for their tax-free bucket. So which one do we do? Why not both? So here's an example for you guys. We have Jim and Jane, they're 30 years old. They have two young kids. They own their house. They currently need $1 million in coverage on each other because they're both working. And that's going to take care of the mortgage, college funding, income replacement, burial expenses, you name it. 20 years from now, those kids are going to be out of the house. They're going to be done with school. The house is almost going to be paid off, and Jim and Jane are only going to need $500,000 in coverage at that point. So what do? You can obtain a 20-year term policy for $500,000 as well as a permanent policy for $500,000. And that's on each of them. So now they are covered for the next 20 years with the million that they need. But once that 20 years is up, that term policy drops off and they only have the permanent policy. So now they can sleep at night knowing they're covered in the case of that the unthinkable happens. They're paying a reasonable premium by mixing the term and the permanent, and they're not going to be overinsured and overpaying 20 years down the line. So how can I help? Springberg Wealth Management is a independent firm, which is awesome for us and our clients. The reason for that is it allows us to partner with almost any insurance company in the country. We work with who we want. There's two main things we look at. One, is that a solid, easy to work with insurance company that can pay their dues? And two, are they offering the best price? So that allows us to really customize our insurance options for our clients, making sure they're getting the best deal and they're working with a solid company. If anybody wants to get in touch, this is my contact information. If you want to send me a message, I recommend email. Not able to message on the company Instagram and Facebook, but email is going to be the best way to get a hold of me. And I appreciate you all for joining.